Welcome to this episode where we'll be going further into some financial matters in a way that we think will benefit our countrymen in Uganda specifically, and Africa, and really anyone that thinks they can benefit from this conversation. Today I am honored to speak to Mr. Alex Kakande, who really needs no introduction because of how he's really put himself out there to help not just himself but everyone that listens to him understand previously very complicated financial terminologies and concepts, make them simpler for the everyday man and woman to understand. And Alex, when you walked in today, I understand you wanted to talk about bonds. Right, so could you kindly take us through what you would want us to discuss today, and most importantly, how you think this conversation and these concepts can benefit the ordinary Ugandan, African, and really citizen of this world make better financial decisions?
Thank you so much, Jean, and you have reminded me that recently I'm being called the Chief Marketing Officer of the Treasury Bonds in Uganda, which it's a title I'm embracing slowly because of the benefits of, for me at large, the capital markets, but in Uganda specifically, what the Treasury Bonds are bringing to the market in terms of investment for people. And to have this conversation, we are going to kind of go deep in the Treasury Bonds, in the Treasury bills, what they are, and potentially what some of the risks might be. This is a conversation I can't wait to have. And I know we have had so many conversations over or I've written quite a number of articles about Treasury bonds, but I'm happy that at least this time around it's going to be in the voice where we talk about this amazing, what I call the amazing product of the capital markets in Uganda. Yes.
All right, Alex, and you know, as a Ugandan, primarily growing up, and thinking where I would want to invest my money, and even really just coming up looking at my own parents and people that were around me. Most people who had some bit of money opted to get into land or property, which is what most of us ordinarily would understand very well. Why bonds? And maybe even before we go into why bonds, what are bonds? What are treasury bonds for that matter? And why should it be a point of concern for the ordinary Ugandan, and why should the Ugandan even be bothered about bonds?
I think the first concept when we think about bonds or treasury bonds, which actually they should be treasury securities, because depending on where we are, we know we have some viewers who are from US, where some are called treasury bonds, treasury bills, and treasury notes. If you're listening to us from UK, they are called gilts, but the concept is the same as the same concept of me lending you money. So we know the first oldest bond is tracked way many years back, over 500 years ago, where this particular person, when the municipal in Netherlands was broke and it had to raise money from the people. So the only way to raise money without raising taxes was to say, okay, lend us money, we shall give you a paper that shows that if we ever make a profit as a municipal, we shall pay you back the money. So they wrote those notes and they called them a bond. A bond is something you could have to move with and say, okay, this municipality owes me money, and you can even pass it on to that. It was the standard way of leveraging lending which was common between individuals, but this time around it was taking on an organization. Now, when you think about treasury bonds, it's the same. You are lending to the government.
Okay.
So it's the same as me lending money to you, and we write a note and we say you're going to pay me back my money. But the difference between the normal lending of individuals and the government here is, the difference starts with knowing that the government, or any government, depending on where treasury bonds are everywhere and treasury bills, it gives you coupons and every single, in a given period of time, then it gives you back all the money at the end of the treasury bond.
Okay.
Yet in the lending, we know in the standard lending, if it's the bank or if it's an individual, we might have to agree where you give me some of the interest and the principal. So, but to understand treasury bonds, think about it as you lending to the government. Actually, it's not think about it, it's that way, that the government uses it to borrow from its local people. Now, there is one other concept which people need to appreciate when it comes to treasury bonds, and without going so much into the complications of it, treasury bonds or treasury securities overall, because it's treasury bonds and treasury bills, it can be a borrowing concept which favors the government through the fiscal policy, where they are raising money to fund the budgets, to fund everything, and that's what we are seeing more and more in Uganda and in Kenya and in Tanzania. Governments borrowing to finance projects. That's a fiscal policy. But it can also be what we call a monetary policy, where the government uses that to get money out of the economy if it wants to control maybe inflation, maybe there is too much money in circulation, maybe the spending habits of the people are too much, and it wants to control that. And one way to control that is to give an incentive for people to invest. And what better way to people to invest? You offer a treasury bond at an attractive rate.
Okay.
So, but treasury bonds is you as an individual or as a company or commercial bank or anyone lending money to the government. On your part, it's an investment because you expect certain principals, coupons, and at the end of the time, you get back the principal.
Okay.
Yeah.
That's quite a lot of information that I think you shared, and you mentioned treasury bonds as a wider concept, and you've also introduced fiscal and monetary policies, which I think is a conversation for another day. I just want to focus on one bit, which is the coupon that you mentioned. That's a term that I think would be quite novel or new for most people. Can we explore that a little more? And maybe as you respond to that question or probe, as an investor, when I invest in a security such as a bond, some of the things I'm going to be interested in or concerned with is what cash flows are usually attached to a bond, or how do I as an investor really benefit from lending the government. And from your explanation, a coupon seems to be one of those cash flows. So can we talk a little bit more about that?
Let's take a step back and use the standard lending. Now, when I'm lending to a family member, I will say, okay, I'm giving you in Uganda, I'll give you 1 million. After 1 year, I expect my money back. Most times, no paperwork, no anything, and even that person is expecting just to give you back 1 million, standard-wise, because no factoring in the time value of money or the risk of me lending. Because most times when you are lending to your family member, your friend, you are extending a hand of help.
Yep.
The other way, when you go to borrow from the bank, it gives you interest. That is the interest charge. They will tell you that's 18% for this particular loan for the 3 years. And that's you have to pay it out for the next 3 years. So in the treasury bonds, that interest is called the coupon.
Okay.
So the language out people need to appreciate is it's the same thing, just that in the treasury world, we call it the coupon, but it's the same language as the interest rate. And what we see is what it means that for every bond that you invest in, the percentage of that's what the government will be giving you. And in Uganda, we have, if you're talking about treasury bonds, you have the 2-year bonds. They have at around 14%. You go to 5-year bonds, 14.125. You go to 10-year bonds, 14.375. You go to 10-year, 15-year, 16%. What that means is that for every 1 shilling that you are investing, you get 16% of it every single year for the time of the bond that it lasts. And then, so that matters so much for your cash flows. Because as you are investing in this product, you can plan ahead and know, if I'm putting in 1 million and I'm going to be for a 15-year bond, which offers 16% coupon rate, it means every single year the government is going to be giving me 160,000.
Okay.
If I'm going to put in 10 million, that means 16% is 1.6 million.
All right.
For those who are loaded, if I put in 100 million, it means the government is going to be giving me 16 million every single year for the next 15 years.
All right.
So the cash flows are predetermined even before you go in, because by the time you buy a bond, any bond, you know what the coupon is. You will know when the payments are going to come due, especially like in the countries in Uganda, every 6 months. And then you can know every 6 months I'm going to be given this particular amount because of the money I've invested in.
Okay.
Yes.
All right. So coupons is just one of the cash flows
Yes.
of a bond and one of the benefits of investing in a bond. Could you talk about any other types of cash flows that could accrue to a bond, or benefits that accrue to a bond as an investment?
That brings me to two things when you talk about benefits or cash flows, because there are the cash outflows and cash inflows in our finance world. But let me first focus on what matters most, the principal or the amount you invest in, which is not necessarily the amount you pay. And that brings us to the concept of the par value or the face value of the bond you are buying. That matters a lot because that's what the government will give you at the end of the bond. So if you are buying a 10 million worth of bonds and you are paying 10 million, there we are saying you have bought the bond at par. So every single time, and if it's a 10-year bond, and which is a 14.375% coupon rate right now, it means a 10 million bond will be giving you 1.4 million on average before tax. Then at the end of the 10 years, the government will give you back 10 million. So that is a critical cash flow you have to factor in, because when you are investing, you can estimate that in 10 years, this is what I'm going to get back. Without any complications. But when you bring in the concept of benefit, the benefits start the day you start to invest, right? And that starts with the price you pay for that bond. And the best way to explain it is, and I've kind of had a conversation with a few people and I've said, imagine when you are buying a plot of land. We all can agree that sometimes the plot of land, we know that plot of land is 10 million.
All right.
But because the demand is high, and that's the only plot of land, the seller is going to say, I want 12. I agree with you, it's 10 million, but I want 12 million. So it happens in the bond world also. When certain bonds are on a higher demand than the supply, there is what a concept we call the premium. So it's something when an investor should always pay attention to make sure you're not overpaying. Because if you are buying land of 10 million and you pay 12 million, and tomorrow you want to sell it, you might struggle to get back at the 12 million. You might get 11. So you have to make sure when you're paying for the bond, it's the same, because at the end of the day, the government will not give you what you paid. It will give you the face value or the fair value of that bond. So the ultimate benefit is always to control the cost, to an extent that right now in the Treasury bonds, majority of the bonds right now are on a discount. And now that flips the coin, which we are talking about, that imagine, or let's use land again. Imagine you are buying land and land is 10 million, but someone who is selling, they have a problem. So they undervalue their land, or they are trying to get their money. So they're like, I have this, I need the money right away. The land which is 10 million, they're like, if you give me 8 million, I'll give you this land. So you sell it at a discount. So that such a concept also happens in the Treasury bond world, where depending where the supply, the demand is lower than the supply, or where the government wants a lot of money than what it, and it's willing to give people at a cheaper price, or so many other factors that might end up determining. But yet, some of the best bonds to buy are bonds that are always at a discount, because it means you are buying a 10 million bond, but you are paying 9.1, 9.2, 9.3. So already the first benefit you're going to make is you're saving 700k day one.
All right.
Yes.
And is this going to be communicated to the investors by the issuer as to whether the bond is coming in at par, at a discount, or at a premium, or is it something the investor has to be aware of? Depending.
Now, when you think about Treasury bonds, think about all Treasury securities, think about two markets. Think about the primary market, think about the secondary market. So this is how the treasury bonds work. You can buy from the primary market, which the primary market is when you buy on auction.
Okay.
In Uganda, you're buying from Bank of Uganda. In Kenya, you're buying directly from the Central Bank of Kenya, the issuer, on a particular date, because auctions happen on a particular date.
All right.
So when you are buying something from the primary market, there you cannot know the price. The price is determined on the particular day that the auction takes place, because the Bank of Uganda, the good people in the Treasury Department, they first have to see what is the demand, what is everyone quoting, for them to set the standard price for retail investors and the non-retail investors, the institutional investors. So yes, you might not know, but at least you can anticipate if you make good research, if you talk to a financial advisor. That's the primary market. In the primary market, I would always tell people it's the best market for someone to get the best price.
Okay.
None whatsoever.
All right. Maybe just to pause on that. I think those are big words. You know, the primary market and the secondary market.
Yes.
Can we explain a little more, just for the ordinary viewer or prospective investor in bonds, to understand what these terms really mean?
Yeah. Thank you so much. So the primary market. Let's use the simplest concept of where most of us buy our clothes from Chikubo, or you go to Intinda to buy clothes, right?
All right, I'm not sure my producer relates with...
if you do not buy from Chikubo, or maybe you might have a supplier who delivers your shirts in your office, or whichever way you buy them, right?
All right.
But imagine if you can go to the producer, the wholesaler, the price you will get from there is the cheapest. Now, in the auction, in the treasury bonds, the producer of treasury bonds, the ultimate owner, who determines what everything, is the government of Uganda.
Okay.
In Kenya, the government of Kenya. So that means when you are buying directly from Bank of Uganda, you are buying in the primary market.
Who is the issuer in this case?
Who is the issuer,
All right.
and the ultimate owner of this bond,
Okay.
of all treasury bonds. So when you are buying from them and you go to their market, which is, it happens on specific dates. For treasury bonds, it happens once every 28 days.
Okay.
For treasury bills, it happens once every 14 days. That way, you need to determine that. So you have to know when the Bank of Uganda is selling, and you have to go and buy from them. It's called an auction because it means there is competition for these bonds and setting the price.
Okay, so the primary market, from what I understand, and I'm sure the viewers hopefully have understood the same thing, is when you buy the bond on issue date from the issuer.
Yes,
That
the owner.
is the primary market.
Yes.
Okay. Then the secondary market is when you buy it from subsequent owners or anyone else that has bought it from the primary issuer in the secondary market. Okay.
That's a good summary of the secondary market. Secondary market is when you are buying a bond from, if you are buying the bond but you're not buying it from Bank of Uganda. Let me use the negative side of it. The negative side of it. If you are not buying the bond from Bank of Uganda, you are buying it on a secondary market.
So where else
now that
it,
can mean
okay,
I'm buying it from my friend. That can mean I'm being transferred the bond by my wife. That can mean I'm transferring the bond to my child. That is all secondary market trades.
Okay.
That can also mean buying the bond from a commercial bank, which is the majority of the trades.
All right.
So when you go to buy a bond from a commercial bank, you can buy it at any day, any time from a commercial bank. You're buying it from the secondary market. Now, at that point, you have to ask yourself, when do I know I'm buying a bond from the secondary market versus when am I buying it from the primary market? Right now in Uganda, where we are still so much on the paperwork, it's all about the paper you fill in. There are two forms that every investor in the treasury bond market should always know. What we call the CSD form 2, it's the auction form, and that form is what enables you to buy from the primary market.
Okay.
So the investor must always make sure they are filling up CSD form 2. When you are buying from the secondary market, you fill up CSD form 4,
All right.
the purchase form, and that form can mean you're purchasing from anyone or even a transfer, because we think about treasury bonds, think about it like any other asset, like where I buy land and I want to transfer it. We are from we are still in a love month where the lovebirds have been given flowers. You can transfer someone some bonds, you know. You just have to fill up that form. Instead of them paying money, you just sign up and say this is a free transfer, and then they will credit them with the treasury bonds.
That's interesting. I just got an idea for the next Valentine's.
Definitely,
Given
definitely.
in giving a flowers this time. But Alex, maybe before we get into the D4s and all the other forms, we'll maybe take a short commercial break before we get into more information about these bonds. But most importantly, when we come back, over and above knowing what bonds are, I would love to understand and appreciate who would be the right investor for bonds, or in what circumstances would it be best to invest in bonds versus any other investment choices. So we'll take a very short break, and when we return, we'll further this conversation around bond.
Thank you so much.
All right, welcome back. Now, in our last segment, Alex, we went into the details of bonds really as a concept, but more specifically around treasury bonds. And we understood a little more about some of the cash flows that accrue to bonds. But as an investor in Uganda, I know there's various options. The more popular one, or the most popular one for most Ugandans, is land. Then obviously we have the stock market and stocks for some of the listed companies. And then obviously now bonds that we're talking about. What are some, in your view, benefits of bonds to an investor over and above the other investment choices? But also more importantly, who is the most or more appropriate investor for the bond market or bonds? Who do they benefit more? And who should be looking at bonds more than probably they should be looking at land or the stock market?
When you think about treasury bonds, there is one thing you should think about: guarantee of your return when you invest. Now, there are not so many businesses in Uganda, or investments, let's call it investments, that you can make in Uganda where you have almost 95 plus certainty that your money is safe and your investment will come back without literally doing nothing. Now, yes, indeed, majority of Ugandans, when it comes to investment, we all want to put our money in land. And especially those who have more money, who buy and flip and sell, buy, demystifies and sell, they make a good living, they make a good return in land, in real estate. But not all of us can do that, right? Most of us, when we think about owning land, it's because we have been landless for so long, or all we have known is that the only investment that I can ever make, and I be called a man to sit on the table of men, is if I own land. Yet sometimes you buy land and you sit with it for 10 years without doing anything, and the return it gives you is abysmal. If you evaluate it from a real point of view. If I buy a plot of land right now at 40 million, 20 million, 30 million, and in 5 years I'm selling it for 60 million, yes, it would have doubled the money. But was that the best use for my money? Right? Is there something more out there that I would have used to get more money? So when you think about that, and that's why majority of Ugandans are people who save every single day, every single month, 200,000, 300,000 in the bank to go and invest in land after 2 to 3 years. And you wonder yourself, if this person knew that they can channel this money into a treasury bond, it can earn them 16% every single year. When you think about Ugandans, especially most of people who are employed, who have literally done either set up a kiosk somewhere, but they can't supervise it, or they have done telephone farming, where every weekend they make a call and then they put some fuel in the car, they drive and they come back with a few cabbages, and they're like, but this investment is not making business sense because you are not there to supervise it. Yes, agriculture has the potential to give you maximum returns, but your capacity and your timing might not allow you to maximize the return in the agriculture sector. Bonds give you that opportunity, that this extra income that you have, that you should have put in the agriculture, come and put it in the treasury bonds. That way you can easily earn even when you're doing nothing, and you're guaranteed that you will earn. It's not going to be when you set up a Chikubo business, where you set up a retail business, or you go to China and import things. Not all of us are going to do that, right? Somehow they always tell us that Chikubo is almost saturated. So none of us are going to get my savings or get a loan and I go to Chikubo and I set up a kiosk, where sometimes the risk, the higher the risk, the higher the return, but it means the higher the losses. Now with bonds, the risk might be there, but because you passively are investing, you are starting with as little as 100,000. Every single person can invest in treasury bonds. That way, majority of the lower middle income people, those are the people who I want to listen to this voice. The lower middle income people and the lower level Ugandans in terms of incomes, because those are the people who can save a 50,000 maximum a month, can save 100,000 maximum a month. They do not have a million, 2 million. They do not even have 20 million to buy an acre of land in Maya and then demarcate it. They do not have that. So those are the people where treasury bonds is the best, or capital markets at large. I know we shall talk about other products of capital markets. Capital markets at large serves you best because, one, you have certainty that your money is not going to get lost. One. Two, you have certainty you are going to get a return which is higher than inflation, if people want to talk about inflation. But three, you have certainty that your money is not just sleeping idle, and you do not need to worry what someone has done or the other one person has done. That even if, and one of the biggest benefits, I tell you, we are Ugandans. In Uganda, somehow that saying, you'll never sit on the table of men until you own your own house. Now the question has become, should I invest? Should I get to this 100,000 every single month and buy bricks by bricks by bricks until 4 or 5 years later when I'm done and I enter into a shell? Or should I invest this money for 5 years, then after 5 years I can go and buy and construct at once? The other flipping coin is always to say, should I even borrow to buy land and be paying this bank 1 million every single month? Or should I get this 1 million, this cash flow, and I put it into the treasury bond, then after 3 years, I go and I buy land at once? Now, you realize bonds are providing these opportunities people wouldn't have thought about. That if, instead of, I tell people, except if from your valuations, which few people do, most times people buy this land for the sake of buying. It's the sentimental value, which is okay. In investments, you cannot value sentimentalism. But instead of you borrowing 30 million to buy land and you're paying 1.2, 1.3 million every single month for 4 years, by the time you are done, you have paid over 50 million. But then by the time you're done paying the loan, that land has moved from 30 to 45. It means you paid 5 million extra that you shouldn't have paid before. Then, yet if you had planned it better and got that 1.5 million every single month and put it into capital markets, in this regard in the treasury bonds, every single month, after 4 years, you will have over 60, 70 million, and you will walk to the same person who wanted to buy it to sell you, and they're like, how much is it right now? Yeah, now it has increased to 45 million. You'll pay them the 45 million and even have a balance. Now, why? Because the returns in the treasury bonds are higher compared to the real estate. Especially for people who bamsonda ampola, bamfuna ampola, the people who have to get one here, one here, one there, one here. By the time they have to make a bundle to make that investment, the bonds provide you an opportunity for you to use that as your building block.
Okay.
Instead of either leaving that money on the savings account to earn 2-3%, either you borrowing where you're paying 16, 18, 19% in the lending rate, so the bonds can flip that coin for you to make a return. So when you ask me what the benefits and which people should target the bonds, first I would say everyone should the ultra wealthy people should diversify. They should have, even if it's 5-10%, and invest in treasury bonds, because if you are worth $1 billion and you are putting 10% of your net worth, which is 100 million, that's a lot of money, and the returns will be really good. Then the higher middle income people, there are benefits that can come with investing in treasury bonds. We shall talk about them in another episode. Okay, planning for their future using treasury bonds. The lower income people, the lower middle income, those who can save 200k, you are a family, you are scrapping by, you can save 300k every single now and then, and that money you're putting it on a savings account. I believe those are the people who should start investing in treasury bonds. Okay. Now, even the lower person who can save 100k every single now and then, but they have an ultimate dream of owning these big assets, land, taking their child to school and everything, the bonds provide them the best opportunity for me. Okay. Because the fact that it's guaranteeing almost 14% a minimum, 10-year bonds 14.375, 15-year bonds 16%, that is an unbeatable rate for so many. Okay. So that's an advantage they can take care of.
All right. What I read from this explanation is that bonds, probably versus the other investment options, are more stable in terms of your cash flows that are expected from your investment, but also the default component, because you talked of, if I was to invest in a business down in Chikuho, I'm likely to lose my investment. Whereas with a bond, my principal is quoting you again, is guaranteed. You also mentioned, I think, a 14% as an average return in Uganda. That's very important to specify. Why are we having these high returns on bonds and we are not able to fetch the same, say, in real estate or even with stocks?
Now that's there are 3 questions there that we have packed in, which I think some of them we shall come back for another conversation for the viewers. One of them is the risks that come to the bonds. I feel like that is an elaborate conversation for me to break down when it comes to the risk. But I'll give you an example. The first treasury bond in Uganda, and I'm using it, was offered in 1969. Okay. That was Obote 1.
All right.
Since then, every single year they have offered the treasury bonds. At one point in the 1990s, when the government, the current regime came to power, they reached even returns of coupons of 20%, 30%. Wow. And not a single day has this government defaulted to pay. Okay. Even at a time when there were change in regimes, which have been happening so much, the good technocratic team at Bank of Uganda, which handles this, and the technocratic team at the Ministry of Finance, which handles the treasury bonds, treasury securities, issuance and payments, they have not in a single day failed to pay. They have continued to pay. So when you look at treasury bonds, if for the last almost 50 years plus, there has been stellar performance of no default of failing to even pay a coupon when it is due, then I would say that gives me a little bit of confidence. 1, 2, you are investing to the government. It's the government. You're not investing to Kakande. You're not lending this money to the deputy governor, Bank of Uganda. You're not lending this money to the PSCT, Mr. Ramadan Gori, of the Ministry of Finance. You're not lending it to you're lending it to the government of Uganda, and the capacity for any government to pay the money is always there. Okay. And like I said, when it comes to the risk, it will be something we should explore more in a longer conversation. Even recently in Kenya, there was a looming cloud of Euro bonds, which have different risks, which we should go in an interesting topic. And people were starting to think the government is going to default.
Okay.
The government, what it did was put in such, press some switch, and people came paying more money, and it paid the other people. Then they will pay the other in 2030, 2031, and like, that's the ultimate power the government has when it comes to monetary policy. So there is no risks. The risk is there, but it's remote, globally. But then when you talk about why businesses have that versus treasury bonds, it's not to part treasury bonds versus the business. It's more to say, who am I? Who is my related party? Who am I doing business with?
Who's my counterpart?
My counterparty. Thank you so much. That when I go to Chikugo, my counterparty is my customers, who today might come, tomorrow might not come. So, or tomorrow might come and they come to me, the next day they might come and they go to my immediate competitor. In treasury bonds, your counterparty is the government of Uganda. In Uganda, in case the government of Kenya, through the central bank. And because of that very nature, you understand that my security starts with that my counterparty is a reputable organization. Then when you talk about the returns, that why do we have higher returns in Uganda versus maybe potentially what people see out there? I'll tell you for the example. In Kenya right now, yield returns, actually even coupons, let me not bring in a different language. The coupons in Kenya are reaching 16-17%. Yes, to an extent someone would be like, oh, are they about to default? Yeah, you can say maybe there is a risk, but it's the government, but they are higher in Kenya than in Uganda. When you go to Egypt, one of the best countries on Africa, I think it's among the top 5 richest countries in Africa, their treasury bonds and their returns right now are around 23-24%. So if you are listening to this and you can invest in Egypt, I would rush to lock in a 23% 10-year treasury bonds, because that's a good return.
All right.
But why? The question of why is so much to say the capital, the return on equity in our countries, with no matter what business you are doing, is still high compared to global economies.
Okay.
If you are investing, I know in financial institutions, that is banks and insurances, for the capital investments from outside countries, the minimum request of return on equity is around 16-15%. So there is a premium we are paying for the fact that we are still a poor country. So majority of the investments in the treasury bonds that are still happening in Uganda, it's still foreign capital. And you do not want to attract a big investment banker to come and put in $1 billion in Uganda in treasury bonds to give them 6-7%. They can go and invest that in US, where they're getting a 5%. Because their question comes in, okay, one, your government might have a risk that it might change. That's a risk. But two, there is FX changes. You see, we are moving from 3.6 to 3.8. Now, all those, because the capital is still so much foreign in our economy, the return is much better. And the two, the incentive,
you try and entice the investor.
The investment, yes.
Okay.
But the other coin also is to entice an investment mindset in our economy. You have to give a little bit of a premium. And so for our people who are investing, if I'm to tell you you're lending government 1 million and they're going to give you 6%, they're like, okay. The question is, why should I do that? It's 6%. Okay. But if they're giving me 16%, that changes the game altogether. So the government understands, the technical people at Bank of Uganda and at Ministry of Finance that set these coupons and these returns, they do understand their clientele. That if I'm going to attract a commercial bank like Stanbic, like DFC, like Bank of Baroda, to invest a portion of their capital into the treasury bonds, I must give them a return that might be higher than what they might go and get from all these other different products. So that is a good thing, that somehow, when you think about the big investors that are setting the coupon, are the big people. Now for me, a retail investor, Kakande, who has my 20 million to invest, I'm benefiting from that. So And because that is a benefit that the government is targeting to give a good return to a big investor, but that's the same return they're going to give me, I should invest because I'm going to get that very good return from there. So when you think about it that way, that's why you see higher returns as compared to global economies.
Okay.
Which it's about demand and supply.
All right. All right, Alex, I think that was very elaborate in helping us understand why we're having these high rates in a country like Uganda, because I'm aware of what's, for example, currently happening in the US and most of the developed countries. You're not seeing 14%.
No.
You're at most maybe seeing 5 or 6%.
Yeah.
So maybe our bonds are pricing in the sovereign risk and any other risks that come with a developing country to entice investors to come in. Now, I know bonds, in other terms, can be classed as fixed income securities. And in my mind, when I hear fixed income, there's always inflation that comes to mind. How does an investor deal with the risk of inflation? And I know you said we can get into the risks that accrue to these types of investments in another segment. But maybe specifically to preempt that discussion, how does one deal with the risk of inflation that comes with a fixed income security such as a Treasury bond for Uganda? Because if I'm earning 14%, but I'm also having to deal with an 8% inflationary rate, is it still beneficial to me?
It is actually, from the numbers that you have said, though I will kind of correct you. If I'm earning 14% and my inflation is 8%, it means I'm already beating inflation. It means I'm getting 6% higher. One, there is this notion when people talk about inflation that inflation only affects capital markets. I think when someone says that, I tell them, maybe you do not understand what inflation is. Inflation affects everything. Inflation affects whether you're investing in agriculture, whether you're investing in everything.
Maybe to just catch it at that point. Assuming I was investing in agriculture, I'm growing cabbages. Okay, then inflation has gone up. I could simply go to the market and tell my sellers, because of inflationary pressure, today's price is not yesterday's price.
Yeah, that's
so.
true.
If you're buying my cabbages at 1,000 shillings yesterday, because of inflation and increase in my cost of production, I'm selling my cabbages for 2,000 today. Whereas with a bond or a treasury bond for that matter, if the coupon was set at 15% when we signed this contract, I'm not changing that. I'm not going back to the issue and saying I now want 17% because of inflation, because it's fixed income.
Have you factored in the cost in agriculture? Because when I tell people,
because the cost has gone up, but at the sale point, I'm able to increase my price.
But somehow your return remains almost the same.
Exactly. Whereas with the fixed income security, if I sign a 15% coupon, that's it.
Has my cost gone up in my bonds?
But my purchasing power from the coupon that I'm earning has gone down.
Yeah, it has gone down. Yes, but one, that's why actually we are getting a higher return, a 14-15% return and above. That's one way to put at it. But two, I also would say there are people who should worry about inflation when you're investing in treasury bonds, right? Okay. If you are investing 100 million and plus, then you'd be like, okay, what are the returns? Because by the time you have 100 million, it means the avenues for you to deploy your capital are higher. You can always hedge around this, right? But if you're investing 1 million, 2 million, either way, you do not have so many options you'd have to use that money for that would be impacted by inflation. Okay. So that means your goal is to maximize the return as much as possible over and above inflation. And we know, apart from the 2022 and early 2023 where inflation in Uganda was 8%, over the last 4-5 years, actually inflation in Uganda has been around 3-5%. Okay. So if I'm getting 15%, and we noticed that in 2022 when inflation was over 8%, the treasury bonds were at 18.5. So those who invested at that point literally had a 10 plus from inflation to the highest coupon rate. Okay. And even in this regard, where inflation is around 4% right now, official results, inflation, the returns is around 15%. So any investor shouldn't worry about inflation. Actually, it should be so much that if you start investing in the treasury bonds, target it at every single 3 months you are making an investment. You take advantage of the changing coupons, changing yields that are influenced by the inflation. That means every time the inflation goes up and they increase the coupon by 1%, you take advantage of that, such that your margins keep going down.
Okay.
So, for me, my message to any investor that is investing in this kind of product, and especially if you are just starting it off and you're just investing like 500k a month, 1 million a month, do not worry about inflation.
Okay.
The returns you're going to make from this kind of investment will outcompete, will outbeat the inflation.
All right.
Otherwise, the alternatives you can also invest in with that little money will also be impacted by inflation, and yet the returns will be abysmal as compared to if you invest in the treasury bonds.
Okay. All right, Alex. Again, this is a very interesting conversation, and we could talk for the entire day. These are very complicated conversations ordinarily, but I'm really amazed by how you're able to break it down, and hopefully the ordinary investor or Ugandan can understand and pick something out, and maybe some of the questions they've previously had regarding bonds as an investment class have been answered. But again, we will be furthering this conversation. We've mostly touched on the returns that accrue to bond investments, but one piece or one side of this puzzle is the risks that accrue to bond investments, which we've lightly touched on, but it's a conversation that I really want for us to get into in our segment. So maybe with your parting shots, Alex, what is your advice to the day-to-day ordinary Ugandan? I'm sorry to use the border guy as the ordinary day-to-day Ugandan, but I think, what is your advice to a border rider who came to you and said, Alex, should I consider bond investments? In very few words.
Soon, we don't know when, everything can be delayed, but Bank of Uganda is working tirelessly to launch a project called the Project Kusevinga, which will allow every person to invest in treasury bonds using your mobile phone, and that would mean any person with just the click of certain buttons, you'll be in position to invest.
Okay.
The fact that the minimum investment you need is 100,000, it means majority of people can invest in treasury bonds. So when you think about that we are about to have a project that will cut away someone going to the bank and signing documents, that gives an opportunity to so many people to start and spreading to invest.
All right.
But that's the quickest way to put it. The other way to put it is to say, if this is the first time you are hearing about treasury bonds, this is something you should learn about. And capital markets at large, right? Treasury bonds in Uganda are offering unbeatable returns at passive income level. When I use passive income, it means you invest in something that you usually do not do anything extra. That's it. Unbeatable returns. I'm willing to bet how many things are out there that people can put in money, and it will give you those returns of 16% per annum, where every 4-5 years your money doubles down if you compound that money. So if you are, this is the first time you're watching it, and the minimum investment you have to invest in treasury bonds is 100,000. Right now, all you have to do is to go to the commercial bank that you bank with. Whether you are a student, you can invest in this. Whether you are 40 years, you can invest. As long as you have a bank account, all you have to go to that bank and say, can I fill out forms that allow me to invest in treasury bonds? The many banks right now, they are offering these services. They have people who understand this and we'll guide you to do that. And start small. I'm not telling you to start with 100 million, even if you have it. I'm not telling you to sell that plot of land. Start small.
Okay.
That money that you leave on your account to save, that's the money you should put into capital markets.
All right.
That's the money you should put into the treasury bonds.
Okay.
And as it starts to grow, you will start to appreciate the returns that you can get in this product. And from there, you even ask so much of understanding more of this. And as we start going through most of these conversations, explaining what these concepts are, you will be on the journey, because at this point you would have invested in this product, you would have known what it is, and you'll be making some good benefits from it.
All right.
Thank you so much.
Thanks a lot, Alex. And I hope someone from Bank of Uganda is listening to this and will compensate you for the promotional bite that you made on their behalf. But I think my parting shots is, these can be complicated conversations sometimes. And if you think you found this complicated, maybe it is. But you don't have to struggle alone. There's a lot of resources. There's so many advisors out there. Feel free to reach out to Mr. Kakande Alex, or really the other members of the BLT that he represents, to provide more information regarding treasury bonds and how you as the ordinary investor can really benefit from this. I think it's a wonderful product, frankly. Again, recognizing that traditionally in Uganda we seem to be siloed in only certain investments, land and businesses in Chikubo. But I think this would be a wonderful alternative for one to consider. So again, it's been wonderful having this conversation with you, Alex, and I'm sure it will benefit one or two people out there, which would really help you achieve your objective.
Thank you so much.
As BLT, as an individual, but also the objective of this podcast and conversation. So again, my name is Jean Akol, and see you in the next episode.